When you expect the market to stay below a certain level, buying puts is not the only way to take a bearish view. You can also sell a call option near resistance and buy another call above it to limit your risk. That is the idea behind a bear call spread. In this video, I will explain what a bear call spread is, when to use it, and how to set it up on FYERS Strategy Builder. A bear call spread is a bearish option strategy used when you expect the market to stay below a particular level. The structure is simple. You sell one call option closer to the current market price. Then, you buy one call option at a higher strike price. Both options are of the same expiry. The call option you sell helps you collect premium. The call option you buy limits your loss if the market moves sharply against your view. So unlike selling a naked call, your maximum loss is capped before you enter the strategy. Now, how is this different from buying a put? When you buy a put, you need the market to fall enough for the trade to work. If the move does not happen quickly, time decay can reduce the option premium. But in a bear call spread, you are not necessarily looking for a big fall. You are mainly expecting the market to stay below your selected level. Since you receive more premium from the call you sell than for the call you buy, time decay can work in your favor as long as the market stays below your selected level. So buying a put is more suitable when you expect a strong downside move. A bear call spread is more suitable when you are mildly bearish or expect the market to stay below a certain level. Now, when does a bear call spread work better? A bear call spread works better when three things line up. First, the market should have a clear level where it has struggled to move higher earlier. This is usually called a resistance zone. Second, your sold call strike should ideally be placed around or above that resistance zone. Third, you should check the payoff, break even, maximum profit, and maximum loss before placing the order. Now let us set this up on FYERS Strategy Builder. In this example, Nifty is trading around 23,500. We sell the 23,600 call option. Then, we buy the 23,700 call option. Both options have the same expiry. So the trade is simple. You collect premium from the call you sell, and the call you buy protects you if Nifty moves sharply above your view. In this example, the maximum profit is around 3,100 rupees. This is the net premium received from the strategy. The maximum loss is around 3,400 rupees. This happens if Nifty moves strongly above the higher strike. The break even is around 23,648. So, for this trade to remain profitable at expiry, Nifty should ideally stay below this break even level. On the payoff graph, the profit zone is on the left side. That means the strategy benefits when Nifty stays below the sold call strike or moves lower. But if Nifty moves above the break even, the payoff starts reducing. And if it moves above the higher bought call strike, the loss gets capped. That is the main idea of a bear call spread. You take a mildly bearish view, collect net premium, and keep your maximum loss defined. Before placing the order, check the payoff graph, break even, maximum profit, maximum loss, and margin required on FYERS Strategy Builder. This strategy is useful when you expect the market to stay below a particular level, move sideways, or fall slightly. It is not ideal when the market is strongly bullish or breaking above resistance. This video is for learning how the strategy works, not a trade recommendation. Please evaluate the risk before placing any trade. Investment in securities markets are subject to market risks. Read all the related documents carefully before investing.